So you guys go ahead and get started. Good luck.
Awesome. Well, good afternoon, guys. So we're Team A, representing Meta. So we recommend a buy of Meta. Our current price as of April 4th was $504.73. Obviously today, there's been a lot of volatility. That price has shot up, I think somewhere close to $570 as of right now. Looking at the price target, it's still undervalued. The price target is $733. That all our valuation in the span of 1 year, of looking at a time horizon for the company stock of 5 years. So, Meta as a company, their goal is to build community through a digital infrastructure, right? We know Meta was originally Facebook when they were created by Mark Zuckerberg back in 2004. When they IPO'd in 2012, and then in October of 2021, that's when they became Meta. In 2011, you see the Messenger logo up there. In 2012, that's where you would see the Instagram logo. And what that first logo in 2014 was when they acquired WhatsApp. And then in the later half of 2014 is when they acquired Oculus, which is now known as Quest, and it's kind of their own virtual reality one, right? They have about 3.35 billion users active every single day. They're very heavy on research as a company in terms of the communication services sector. They have a 13.16% market share, and they're very excited to continue to invest in virtual reality over the next year. They're looking to spend about $20 billion. So in terms of the industry, they are in the communication services sector. In terms of the S&P is about 10.7%. With the communication services sector, very fast-moving sector, but with Meta having such a strong market share, they're able to continue to adapt and move the punches. In terms of the digital content creation industry, we're looking at a compound annual growth rate of 13.9%. Artificial intelligence being a very high aspect of that, and Meta holds about 70% of the virtual reality market, so they are really looking to continue to hold that market share and invest in it to make sure that they are the leading force of that industry. Now, talking about looking at them compared to the Spider, you see in early 2023 the graph compared to the Spider ETF shifts drastically. That's when Mark Zuckerberg, in an earnings call in the middle of February, announced that this was going to be their year of efficiency, and ever since then they have completely outperformed the rest of the sector. And then looking at some competitors, Snapchat and TikTok are their main competitors. Snapchat's Prime. Looking at that first graphic, their Prime was COVID.
I'm sorry, I don't want to stop your flow, but also I see that we've got an issue, and we can fix the issue on the presentation.
Absolutely. Okay. I know, it's like...
I thought it was just one page, and I'm like, I hate to interrupt you. You guys are rolling all your stuff, and I don't know, the one I just pulled up on mine, maybe I can put that up here, because it's working fine. Sorry, guys. I didn't know whether it was worse to stop or not stop.
Fair enough.
This is not a glitch on their fault.
Yes.
Is that the first to fix that?
There you go.
Not sure why. Sorry. Is it better to interrupt?
I would say yes. I would say yes. That's a very
But I have to say you handled it well.
I know you prefer, explaining the chart. It
seems like it's except for it's not. Because I'm in front of the thing.
Yeah.
There we go. All right. There we go.
So when I was talking about Facebook and all those graphics, that's good.
Beautiful.
Okay, let me just close my email so notifications don't come up in the middle of your presentation. Thank you, guys.
Do I need to
Should adjust the clock.
I think I was showing the graphic. Yeah, I should have there. So there you go. Get back into it again. That's where, in that early February section, that's when Mark Zuckerberg talked about Meta looking to be more efficient in terms of the way they manage their money. And ever since then, it has significant growth compared to the rest of the industry. Now, I was looking at the competitors. So Snapchat was very big during COVID, right? That's when people were able to communicate online, send pictures to each other, and they've had a big struggle in terms of continuing to keep users on. They had to make Snapchat Premium over the past year just to continue to stay afloat in terms of revenue. So in terms of that company, they're looking at a steep decline. TikTok, President Donald Trump, about a week ago or so, pushed back the lawsuit another 90 days. So they're really just hanging on by a thread until that lawsuit gets figured out. Google is where they kind of compete in terms of ad revenue, but Google tends to stray more towards that search aspect where your Google's going online, you see pop-up ads and things like that. Well, Meta's strength is using social media for their ad net revenue, where people are continuing to watch videos and things like that. And Microsoft is just trading a little bit more, trading at more time than Meta.
So moving into the investment thesis, there's three things that we really want to highlight. First, their really strong presence within the advertising industry. This is where the majority of their revenue comes from, and we see this as a huge growth driver moving into the future. Something I think is really overlooked is their expansion into emerging markets. Places like Latin America, the middle class is growing, smartphone adoption is increasing, and so Meta's early presence there is going to play really big dividends in the long run. And then finally, something that's kind of on everyone's mind is investments in AI. They're really committed to building out their infrastructure. So just to move into some more tangible things. So firstly, they've seen a 21% increase in their year-over-year advertising revenue, just showing their ability to continually increase in this growing market. This has led to 8 consecutive quarters of exceeding their profit estimates. And as we talked about with that massive AI investment, they've committed $65 billion to building out AI infrastructure. This is specifically in America, which is a really advantageous point that a lot of other companies are second movers on.
Okay, now let's address the biggest risk facing Meta, which is the current tariff situation. So these slides are as of last night. That's about 2 hours ago. There was now 125% tariff on China and a retaliatory 84% tariff on the USA. And this affects Meta in 2 different ways. First off, ad revenue. There's $11 billion of ad revenue comes from China and $18 billion from China in total. And about 12% of Meta's total supply chain is in China. And these industries will be very affected by the current tariff war, and especially the ad industry. Meta makes 97% of their money off ads, and in a period of economic recession, that means that ad revenue will be going down by a lot. And additionally, for another 75 major U.S. trading partners, there's now a 10% blanket tariff for the next 90 days. However, this does affect the EU, as the EU has imposed retaliatory tariffs against the U.S. about 25%, as of today as well. And the EU poses about 30%, or about $30 billion of revenue for Meta. And so the major concern with the tariff issue is that it's a period of uncertainty, as no one knows what will happen next. And every day tariff rates seem to go up or totally cut off, so it's a period of heightened uncertainty.
Sure. So in terms of the income statement, Meta's total revenue was $165 billion over the past year. Their big thing is their cost of revenue, right? They keep their cost of revenue to only about $30 billion, allowing them to have a gross profit of $135 billion, or a 20% increase in terms of the past year. And with them being smart, in terms of how they manage their money, it gives them the chance to then continue to invest in that virtual reality sector or artificial intelligence, which you can see they spend about 1/3 of their total expenses, or a little bit more than that, into artificial intelligence infrastructure. Now, when we look at them compared to other companies, we can look at their gross profit margin. They have a significantly better gross profit margin compared to Amazon, Google, Microsoft, which in my mind, you see those bigger companies and you want to think about how they manage their money. And in terms of companies, the way that we can evaluate them is based on how efficient they are with the money that they're making and how are they able to continue to invest that and turn it into more money so they can continue to be a stronger company.
And now let's talk on the balance sheet. You can see that in the last 12 months, Meta has performed very well. They have grown almost 20% in the categories of total assets, retained earnings, equity, and cash, and short-term investments. However, the total liabilities has also grown by 20%. This is a byproduct of their cash flow from investing growing about 90%, which is an indicator of their growth into the AI sector and Mark Zuckerberg's push into AI. Additionally, to continue the point of efficiency for Meta, we have the return on equity, which is go back to which is 38%, which is head and shoulders above their nearest competitors, indicating how efficient Meta is with their money. Next slide. An additional stat to show Meta's efficiency is their current ratio or liquidity ratio, which is at almost a 3, which is almost 3 times Amazon's, and head and shoulders above their nearest competitors, also indicating 2 different things. First off, Meta's efficiency, and second, Meta's ability to survive a tariff war, as they're very big company with a lot of cash.
So moving on into the cash flow statement, they've seen a 28% increase in their year-over-year operating cash flow. This just shows they're really effective at reducing their margins. They've also been able to commit $30 billion to stock buybacks within the last year. This is because of their $58 billion free cash flow, which once again will free up opportunities for investments and other opportunities.
Perfect. So at this point in the presentation, we've heard a lot about fundamental analysis, and so now we'll perform some technical analysis to look at the stocks chart. So this first chart showcased is Meta's 2025 year-to-date stock chart performance, and as you can see, we have clear and healthy price action, but with well-defined swings in either direction. And a few statistics I'd like to point out, with the highs so far this year being 740 price level, the low being around the 480 price level. We can take a look at the RSI, the Relative Strength Index, which measures consumer sentiment in terms of buying and selling shares. They're oversold a little bit through April, but however, currently year-to-date, they are moving towards that 45 to 55 level, which is a signal of breakout. Next slide, please. And then, of course, early in the presentation, we heard about a 5-year time horizon, so we'll take a look at the 5-year chart, so 2020 until 2025. And so, for this chart, we can see they're holding very bullish ever since 2022, 2023. They've been performing with their higher highs and higher lows ever since then. I'd also like to point out that they broke their 2021 resistance level of about 350 price level. And ever since then, they've been holding steady channels. And this is the ultimate conviction that with Meta's initiatives moving forward, these things will be priced into their stock, ultimately driving downward momentum.
For our evaluation, we did 3 different measurements: analyst ratings, DCF, discounted cash flows, and a Monte Carlo simulation. We weighted these 50%, 40%, and 10% respectively. We chose to rate analyst ratings and DCF higher than the Monte Carlo simulation because we believe they showed the fundamentals, technical analysis and stuff a lot better than the Monte Carlo, which is but a simulation and a statistical model. We used the closing price as of April 4th at $504 to calculate each of these values. For discounted cash flows, we use historical averages and trends to choose the future cash flows for them. With that, we found that an upside of 67.2% with a 843.91 intrinsic value for them. And for the analyst ratings, we averaged from 10 different sources of the analyst ratings for each one of them. That way to get a general consensus of what analysts think the stock will do. With that, we found a potential upside of 35.07% and an intrinsic value of $681.74. Finally, we did a Monte Carlo simulation where we took the past values from a 1-year time horizon to predict the future average stock price over time, which worked out to be $558.01, making Meta undervalued by 10.48%. Overall, combining these all together, we recommend a buy. We recommend a buy to the target price for $733.78 with 45.37% upside. These numbers are all calculated for a 1-year time horizon, but we believe that Meta will be able to maintain a strong foothold for years to come, so we recommend a long-term buy. Thank you. Questions?
So, they have some massive capital expenditures starting, I guess, now or last year. I don't know that. What's the number? 45 billion. But what does free cash flow look like in, we'll say, 24 versus 26? 2 years down the road. Is it significantly higher? Is it lower? What is it?
Sure. In terms for Meta, it increased quite a bit from.
Yeah, so they've seen really consistent growth. Their ad revenue is a really large part of that. They've seen 20% increases in their advertising revenue. We expect that those trends are going to continue. Obviously, as we mentioned, tariffs are risky because a recession would likely decrease their total ad revenue, obviously, but we expect them to see consistent earnings growth of 15%, and free cash flow should increase at similar levels.
Yeah, so this is something I got from the Bloomberg, and it shows a couple of their key financials with future estimates for those. A lot of these estimates are what I use how to create the DCF, and also going to use.
Yeah, so free cash flow will be second from the bottom. So in 2026, estimated 53 billion.
And you talk about ad revenue. I think in terms of telling the story, ad revenue is just going to continue to grow. As they continue to grow on Instagram and other social media sites like that, they are going to have this money because people are wanting to be shown on their platforms. That's where us as humans go to be able to look for information, and so the ads get more traction, and therefore they don't have to go out and spend a whole lot of money to get people to come to them. A lot of people are going to come to Meta and say, hey, we want to be on your platforms, and therefore they'll be able to continue to smartly handle that money and increase their future cash flow.
How many years you got on your DCF then?
Yeah, we just have.
I think
Did
it's
you
5 years.
guys continue to model the high 60s, 60 billion in CapEx all the way after your 10, or did you taper it off?
So for each of the different percentages, I looked at the different numbers for from a bunch of different sources, especially Bloomberg, and just found kind of followed the same trends they've been following. Kind of under the assumption that history will reveal itself, of course. Not completely the case, but I advise for what information you can bring.
Okay.
Okay, so did you guys build an income statement?
Did we go over income statement?
Did you build an income statement?
We did not, but we used like their income statement off of
Okay.
the
I mean,
stuff as finance, but
so did you forecast out revenues?
Yeah, it should be, if they know the DCF, it should be the top one.
Did you make any assumptions on the forecast out?
when you were going through the DCF, did you make any?
Yeah, so these.
Hey, you don't have to show, right? I mean, I'm trying to be consistent across teams. I'm asking,
Sure.
I want to make sure you understand, I mean, how do they make money? I mean, yeah, we know they make money through ad revenue. Give me the mechanics of how they make money. I mean, in other words, if you're building up a revenue line on an income statement, how do you forecast that?
Yeah, I think in terms of, you look at how many people are continuing to use their platforms, and so you want to see, like, are companies continuing to go to them to look, to use them as their platform for their main source of revenue, and so as you see bigger companies continue to utilize them and utilize their platform, you see, 3.35 billion active users, right? Companies want to go see that, so you look at, I mean, I guess, we didn't specifically do this, but I'm assuming in terms of the numbers that we were finding, they're looking at bigger companies, and as they continue to toss on more companies with contracts of having them come to them and use their platform, that's where
Well, let me simplify. In other words, if you're putting this on Excel, cells A, B, and C, what times what turns into revenue that feeds into your model. In other words, how do you get to $1 of revenue on the model? In other words, they're paid ad revenue, right? In other words, this all builds up. How do you put this into numbers so you can forecast it?
I think,
But I think for this one, like each of those, like for using specifically like Bloomberg to find some of these values, sometimes it did show like increases from just like numerical, like it wasn't in percent, so I converted it purely by finding those values in there, and kind of be able to do that with each different setting of that. If that answers your question.
time.
I got a question. Like 5 minutes. And I'm going to say, ask you, 50% of your valuation model is based on somebody else's estimates, analyst estimates, right?
Right.
So was there a range in estimates in the analysts? And did you look at highs and lows? Did you look at which analysts are better at predicting? And did anybody have a sell recommendation? Did you look at that, or did you just kind of take it as face value for your analyst recommendations?
Yeah, so for each of these, each of the websites typically, from what I saw, they had the what people predict is going to rise and fall, and for the most part, when looking at most of them, there was only I think each of them, there's probably an average 50 analysts per one of these that would make an estimation, and usually, I think the most I saw was like 4 that recommended a sell, which comparatively is,
You push them all together, I'm sure, over the course of, you got 10 offices, if you're using 50 analysts a piece, it's going to be 500 total, and therefore your sales.
yeah, that's part of the reason why I use 10 different sources, that way you kind of get the general consensus from everyone instead of I don't know, CNN might say, well, they're doing a lot better than something else just from bias point of view and stuff like that. So just by diversifying.
Yeah,
get rid of that.
I was, not a criticism, just, sell-side analysts tend to be pretty optimistic by nature.
Yeah.
All right, and you guys are really tired.